Look at that number on your screen. It's a paycheck from 2026, but the amount in the bottom right corner is bleeding out faster than you can blink. You didn't lose your job, and your employer didn't cut your salary. Instead, the money is vanishing before it ever touches your bank account, hidden in plain sight as what we're calling the ghost deduction. This isn't just one tax bill waiting in the mail. It's the cumulative result of income you thought was safe but wasn't fully reported, penalties for taxes you deferred last year that have now compounded, and specific adjustments unique to the 2026 tax landscape that silently shrink your net pay. Imagine you saved $200 a month in a side hustle last year and reported only half of it. That $100 a month gap looks small, but when the 2026 tax authorities run their new automated cross-checks, they don't just see a small error. They see a pattern. Suddenly, you owe back taxes, plus interest, plus a penalty that hits you hard. Now add deferred taxes from previous years that have piled up due to delayed filings. By the time the bill arrives, the interest alone could have grown your original mistake into a massive chunk of your current income. And don't forget the 2026 specific adjustments, changes to deduction limits, new reporting thresholds, and stricter rules on asset valuations that might suddenly reduce your allowable write-offs. These aren't minor tweaks. They are the invisible forces eating away at your paycheck right now. Your net pay is shrinking, not because the economy is failing, but because the rules have tightened and your financial picture is more exposed than ever. Think about the last time you got a raise, only to see your take-home pay barely change. That feeling of a paycheck shrinking isn't just the economy breathing down your neck. It's because the rules have tightened and your financial picture is more exposed than ever. Starting late 2025, Congress moved the goalposts by enacting specific legislative changes that lifted the federal income tax brackets and adjusted the standard deduction thresholds for the 2026 filing year. On paper, these moves look like relief, but in practice, they created a scenario where marginal tax rates jump unexpectedly for mid-income earners due to bracket creep. Imagine you made a steady $95,000 last year. You might have thought, my tax bill is capped, but the shift in brackets means that as your income nudged higher, a larger chunk of your earnings suddenly slid into a higher tax tier. This isn't just a rounding error. It's a structural shift that hits you right when you're trying to plan for the future. Say you save $200 a month for an emergency fund, expecting it to grow predictably. Instead, the unexpected bracket jump eats into your savings rate faster than anticipated. It's like walking up a staircase where every few steps, the stairs get steeper without warning. The government didn't necessarily raise your tax rate directly, but by widening the gaps and shifting the thresholds, they ensured that for many, the effective tax burden increased silently. This is why your net pay is shrinking, not because the economy is failing, but because the rules have tightened and your financial picture is more exposed than ever. You have to look closer at your paycheck details to see exactly where that money is vanishing. Imagine you deposited $1.5 thousand into a crypto exchange last year and never received a Form 1099. You might think, well, that's my money, no tax was taken, but in 2026, the IRS is rolling out advanced AI systems that don't just wait for you to report them. These new algorithms automatically cross-reference your W-2 filings with real-time data from hundreds of crypto exchanges, gig economy platforms, and even merchant processors. If your W-2 shows $60,000 in income, but the AI detects a pattern where your crypto deposits total $12,000 more than what was reported, it flags the discrepancy instantly. That gap doesn't disappear. It triggers an automated ghost assessment that calculates the unpaid tax, interest, and penalties as if the transaction happened yesterday. Think about the last time you received a large wire transfer or a Bitcoin airdrop that wasn't immediately converted. The system now treats those untaxed flows the same as a missed paycheck deduction. Suddenly, your financial picture is more exposed than ever. You have to look closer at your paycheck details to see exactly where that money is vanishing. It's not just about hidden income anymore. It's about the invisible layer of transactions the AI is stitching together behind the scenes. One small oversight in 2026 can turn into a massive surprise bill next quarter, especially when the machine flags a mismatch between what you earned and what you declared. The technology is faster, smarter, and far less forgiving than the human auditors of the past. Consider the last time you received a payout for a small gig, maybe a $500 payment from a platform for a quick design project or a freelance article. In 2026, The rules governing how these smaller transactions are reported have shifted dramatically. The 1,099K thresholds that once acted as a safety net for minor earnings have expanded, meaning that even modest activity can now trigger a formal information return to the IRS. This isn't just about big payouts anymore. It's about the granularity of tracking. Where once only large, aggregated sums might have slipped through, now every transaction under the new, lower reporting limits is captured with digital precision. Imagine you saved $200 a month in various small deposits or received $3,000 total from multiple microgigs throughout the year. Under the old system, this might have been overlooked or assumed to be tax-free income below a certain radar. But in 2026, those fragmented payments are bundled and reported, creating a clear trail that your tax software must explain. If your original budget assumed you only paid taxes on your primary salary, ignoring these scattered 1,099K incomes, you suddenly face a hidden self-employment tax liability. The technology behind the reporting is faster, smarter, and far less forgiving than the human auditors of the past, automatically flagging discrepancies between your reported income and the databanks have on file. Suddenly, that $3,000 looks like $4,000 in taxable income when combined with other sources, pushing your effective tax rate higher than you anticipated. The mismatch between what you earned and what you declared widens, forcing you to confront the reality that your paycheck is shrinking faster because your true income footprint has grown in the eyes of the government. Consider the last time you earned a small reward from staking some crypto assets you held in a decentralized exchange. Or maybe you sold an NFT you had been collecting for years. You didn't necessarily move a lot of money, and you might not have even thought about taxes because the transaction happened on a platform where the money just appeared in your wallet. But under the new 2026 regulatory mandate, every single one of those actions now counts as a taxable event, no matter how long you've held the asset or how small the profit. That means if you staked $1,000 worth of tokens and earned $50 in rewards, the government treats that $50 as income immediately. And if you sold an NFT for $200 more than you bought it, that $200 is added to your capital gains, even if you held the NFT for 5 years. It's like a ghost deduction is happening in reverse, a phantom tax liability that grows silently in the background. Imagine you saved $200 a month in crypto rewards over the past year and never filed them because they felt like free money. Now, when tax season rolls around, that $2,400 sits in your taxable income, and depending on your bracket, you could owe hundreds or even thousands in extra taxes you never prepared for. Your paycheck might look fine, but your true income footprint has expanded because the rules now catch every digital transaction, forcing you to confront the reality that your financial life is far more visible than you thought. Think about how your paycheck disappears before it even hits your bank account. For a long time, remote workers could live anywhere and pay taxes only to their home state. But in 2026, states like New York and California have synchronized their tax codes to close that loophole. Now, if you earn money while physically located in another state, you can be taxed by both your home state and the state where the work was performed. This means your income is effectively subject to overlapping jurisdiction rules, creating a situation where you could pay double taxes on the same dollar. Imagine you saved $200 a month from a remote job while working from a different state. Under the old rules, you might have paid only your home state's tax rate. But under the new synchronized codes, you could owe taxes in both places, instantly doubling your financial burden. Say you earned $5,000 this month. Instead of one state claiming its share, 2 states could each demand their portion, leaving you with significantly less in your pocket. This shift doesn't just affect big tech companies. It impacts anyone earning income across state lines. The rules now catch every digital transaction, forcing you to confront the reality that your financial life is far more visible than you thought. You are no longer invisible to the tax systems of multiple jurisdictions. Instead, every step you take outside your home state creates a new tax obligation, shrinking your take-home pay faster than before. Think about the last time you pulled your bank statement, noticed your monthly loan payment creeping up, and didn't have a clue why. You might assume your salary just increased, but if you borrowed money to buy that car or fund your new business, the Federal Reserve's aggressive rate hikes in 2026 have quietly turned interest into a de facto tax on your cash flow. Consider the last time you secured a small business loan or a line of credit. Back then, rates were low, so your monthly payment covered just the principal. Now, with borrowing costs spiking, A leveraged company suddenly sees its debt service balloon. Imagine you owe $20,000 at a historical low rate. Your payment might be $200. But if rates jump to the 2026 levels, that same $20,000 could demand a $600 monthly payment. That's a $400 increase purely in interest, hitting your operating budget hard. For many small businesses, this isn't just an extra expense. It's a direct hit to net operating income. In fact, for heavily leveraged firms, debt interest can now consume 15 to 20% of their total operating revenue, effectively acting as a silent tax that shrinks what you can reinvest or distribute. It's like paying the government without filing a return, hidden inside your balance sheet. You thought you were protecting your cash reserves, but the rising cost of capital is draining them faster than ever. Every dollar spent on interest is a dollar not spent on inventory, payroll, or growth. This is the ghost deduction at play, eroding your profitability from the inside out, turning what was once a manageable overhead into a massive drag on your bottom line. Think about how your business cash flow gets quietly siphoned away by administrative penalties you might not even realize are hitting your account. In 2026, the landscape for small businesses has shifted with new administrative fees layered on top of existing tax obligations, specifically targeting those who file returns late or miss estimated tax payments. These aren't just minor filing costs. They are compounders that can spiral out of control. Imagine you owe taxes on income you received last quarter. If you didn't file your return by the deadline or your estimated tax payment was off, the government doesn't just wait. They apply a fresh layer of administrative fees designed to cover the processing complexity of your delayed submission. On top of the standard interest, these new 2026 fees can jump in quickly. For instance, say you had a taxable liability of $20,000. A standard penalty might start around 0.5% per month, but add the new administrative surcharge introduced this year, and suddenly those monthly chunks add up to thousands of dollars in fees alone within a few months. What makes these ghost deductions so dangerous is their compounding nature. Each month the return sits late, the fees grow, and the total amount owed can eventually exceed the original tax bill itself. It's like a snowball rolling downhill, gathering mass and speed until it becomes much heavier than the hill you started on. By the time you finally file, you're not just paying what you owed in taxes. You're paying a significant premium for the delay, turning a manageable overhead cost into a massive drag on your bottom line that eats into your profitability from the inside out. Think about how your take-home pay might vanish if you ignore the upcoming changes. You aren't just looking at the gross number on your pay stub. You are looking at a shrinking future. Here is your concrete action plan to stay ahead. First, gather your 2025 income statements and your projected 2026 earnings. Plug these figures into the new 2026 tax brackets, adjusting for any deferred tax liabilities you've accumulated. For instance, if you save $200 a month in 2025, imagine that same amount now faces a 22% tax rate due to deferred obligations. That deferred tax liability could amount to roughly $440 annually, turning a manageable overhead cost into a massive drag on your bottom line that eats into your profitability from the inside out. Next, take 25% of your gross income specifically for these new hidden costs and set it aside in a dedicated high-yield savings account. Do not touch this money for daily expenses. Treat it as a mandatory buffer for the ghost deduction that lurks in the background. By the time 2026 rolls around, this reserve will cover your unexpected tax hikes, ensuring your cash flow remains stable. Finally, review your expense reports quarterly. If your deferred tax liabilities grow, adjust your savings rate accordingly. This proactive approach ensures you're not just reacting to the tax man, but staying one step ahead of him. You've been doing the work. You've been paying your bills, saving what you can, and planning for that future you've been building. And yet, here you are, wondering why your paycheck just isn't enough. That gap, that's where the ghost deduction hides. It's not a mistake on your end. It's not something the system is trying to punish you for. It's simply a hidden layer of taxes that slips through your awareness, quietly eating away at your hard-earned money every single month. Now that you understand what's been happening, you have the power to change the narrative. Don't just watch your finances shrink. Start reclaiming them. The first step is knowing exactly how much you're losing and where. That's why I've built the 2026 Tax Shield Calculator, completely free and available right now in the description. It's designed to help you uncover your own ghost deductions, see how much you could be keeping, and adjust your savings strategy with confidence. I want to hear from you. Have you ever noticed your take-home pay drop without knowing why? Did you find yourself short on savings only to realize taxes were higher than expected? Share your story in the comments. Whether it's a surprising deduction you uncovered or a question about how your paycheck is really being split, your experience helps others understand the invisible forces at play. Together, we're building a community of financially aware taxpayers, ready to face the new year.